Good evening, and welcome to another episode of the Weekly Market Wrap. My name is Daniel Ang, and today, of course, is February the 2nd, 2025. And for those who are still celebrating the Chinese New Year, Happy New Year to all of you. And today we're going to cover what happened this past week, in particular to what Donald Trump has actually been doing in the marketplace. And of course, we're going to talk about the biggest event so far this year, in regards to DeepSeek, the Chinese AI company that upset the apple carts for a lot of Americans' AI companies. So today we're going to cover quite a fair bit, and particularly on the topic of Donald Trump. Now, of course, before we get into the content itself, let me remind you that this presentation is not an offer to buy or sell any securities, be it FX futures, CFDs, or any kind of margin financial products. The trading of any kind of margin products do carry risk, so do understand your own risk profile before you attempt to trade any of these margin products. Now, I'll be sharing with you my views of the various markets, and do understand that those are my views and has got nothing to do with the sponsor IronFX, a sponsor that has been sponsoring my event for quite some time now. And of course, this content, what I'm going to share with you this evening, has not been vetted by any regulatory bodies anywhere in the world, in particularly Singapore. Now, again, I want to reiterate, that the IronFX is the sponsor for this presentation here. Now, first off the bat, on Monday, when the market opens, actually the market already knew what is happening over the weekend. Some 8 days before from today, we knew that there is a Chinese AI company, a very small outfit, for a matter. The name is called DeepSeek, and this is a side hustle for this company that was actually doing quantitative trading. Okay, and they developed a AI model purely because they have the chips to do so, and what they came up with was a model that was on par, if not even better than what OpenAI has been offering so far. And that caused the market to go into a tailspin. And when market reopens on Monday itself, okay, and we saw that Nvidia, which has been the hot favorite in the tech stocks on Wall Street, took a nosedive, a very severe nosedive for a matter. Its stocks went down 17% in a single session, wiping out practically $600 billion of its valuation. So the impact is still reverberating, although on the following day, we see a bit of a rebound in Nvidia's shares. But on Friday, again, we can see the sellers are back in full force. So what is going to happen is that it's going to be made worse by what Donald Trump is doing in the marketplace by imposing universal tariff on both its two largest neighbor. Principally, we have Canada and Mexico being slapped with 25% tariff starting tomorrow. So that is going to cause the market to go to another round of tailspin. I suspect when the market opens in Asia tomorrow, we're going to see a bit of a butt bluff. So be prepared for it, okay? So already damaged by the nosedive in tech stocks on Wall Street, we can see that the market is totally damaged, technically speaking, as well as fundamentally speaking. Okay, so this sentiment is likely to linger for the next few months going forward, but I suspect this is probably a buying opportunity, and I will tell you why I think so later on when I come to the charts. Now, this is the other thing that has been happening. Donald Trump finally put into practice what he has been telling us during the campaign trail leading to the last November presidential election, and that is that he is going to impose universal tariff on both Mexico and Canada. And these two are U.S. largest trading partner right now, other than China. And of course, he also imposed an additional 10% tariff on China on top of the 17% that is currently outstanding. So we can see that this universal tariff being imposed is going to cause concern about the resurgence of inflation within the United States. In fact, it will be a global inflation, because if anybody is selling to the United States, will be faced with a tariff, and it will ultimately weaken their own economy. And if their economy is weakened, their currency is being depreciated as a result, there will be less demand for American products and services going forward. So this could lead to a global inflation for all we know. And of course, we also have the lingering war that is still ongoing in Europe between Russia and Ukraine. So all in all, we can see that the clouds hanging over the global market is actually quite dire. Okay, so let's explore further. Now, the other thing that Trump has been doing this past week itself is to uh, issue a what you call it, a firing order to basically all federal employees. And of course, federal employees refers to everybody's on the federal payroll, whether you are a policeman, whether you are the army guy, or whether you are a fireman, or whether you're a nurse. You will all they were all been asked to resign. Okay, and the way they did it is very reminiscent of what Elon Musk did when he actually took over a Twitter, now called X. What he did was to offer a payout to all employee, and for those who actually pick up his offer will be asked to leave, and he slowly re-employ them again on a negotiated package thereafter. So I think what Elon Musk is doing for Twitter, I think Donald Trump took a leaf of his experience and is also doing the same thing. But however, there are pushback right now. There are many states that actually has been suing Donald Trump for doing that because they consider it to be illegal because the president do not have the legal right to fire federal employees. Okay, but the way the Trump administration through his press secretary has been telling us is that this is a temporary arrangement. It is not necessarily a permanent arrangement. However, since then, Donald Trump has rescinded his order, and maybe he realized that he's not on very strong legal ground here. But again, the damage is probably done, and we are beginning to see on a lot of social media that veterans, for example, are now complaining they have not been receiving pay for more than a month, and they may not necessarily be paid going forward. So going forward, I think those people who have voted for Trump now is beginning to regret their action. And of course, what we are seeing here is something that's still unfolding. We do not know how much damage this will do. But however, to lose your pay package is going to be quite devastating to say the least. Okay, so this is what is currently happening. And in his tariff against Canada, US import a lot of energy in terms of oil and gas from Canada, and to the tune of something like 4 million barrels a day, and US cannot do without Canadian oil, okay, because the US refineries are built to process heavy crude, okay, not something that the US is producing themselves, okay, because it's of a different grade. So the inability, or rather the restriction on Canada imports into the United States, I think Canada is going to latch on that and trying to see if they can get some kind of leverage over Trump to come back to the negotiation table. But I think Trump is basically not blinking just yet. Well, we're going to see how things will unfold. Canada has already said that they will retaliate, but they're going to be selective. And I think they knew that their tariff is a little bit different because they are targeting the Republican states, meaning to say the red states. Okay, and this is going to be very interesting because for the first time we can see tariff being imposed along party lines. Okay, so we will have to monitor how this is going to play out. By the way, Trump said that he is going to delay for about 2 weeks to see how the universal tariff is going to play out first before he wants to impose the 25% tariff on the Canadian oil. Right now, he said that he may actually not impose 25%. He may actually consider 10% tariff on Canadian oil and gas imports. So again, we will have to see, but I think the refiners in the States is now going to be very concerned where are they going to get their principal oil for refining, okay, because the other place that US actually import their energy needs is from Mexico, and Mexico Prime Minister, or rather President, has already said that she will retaliate, although she has not been providing any details. Okay, the president in Mexico, called a lady called Claudia Sheinbaum, said that she will definitely retaliate, and Donald Trump has also said that if there's going to be any retaliation on his tariff, he is going to opt those tariff rates. Again, this is an eye for an eye, and we all knew what will happen if this go into the uncontrolled retaliation. You up my rates, I up your rates, and then we up again, and then this is going to lead to a lot of chaos in the marketplace. I think the markets, in terms of Wall Street, will not like what we are seeing here, and I think they were going to react very negatively in the coming weeks. Now, next, we are going to go into the data that have been released this past week itself. We start off with China. Now, China purchasing managers took a dip. Okay, as far as we can see, the numbers has not been good. The non-manufacturing has actually taken a dip, which is quite a shame because in December it was at 52.2, which is very, very good, and it dropped 2 percentage point to 50.2. Now it's bordering on contraction zone, and of course, the manufacturing sector has always been bad. Now it has gone from bad to worse, from 50.1, which is a borderline case in December. Now it's dipped down to 49.1. So this is officially now in contraction zone. So this is definitely not a good development. Chinese equity markets has been underperforming, and unless the Chinese government come out with some stimulus package, it's going to be very difficult to see how this can be arrested, okay, in terms of the equity markets in China. Okay. Here we have Australia's CPI numbers. You can see CPI numbers has been dipping, okay, but it's a bit mixed. Quarter on quarter now, the way the Australian and New Zealand measure their CPI is on a quarterly basis, unlike elsewhere where it's measured on a month-to-month basis. Okay, in the last quarter in Q4 of last year, Australian CPI numbers remains stable at 0.2%. It is not increasing, but it's also not decreasing. Now, year over year, we can see there's a very obvious spike in the CPI numbers. We can see that since September, October, where it is actually bordering on 2.1%, now it has been elevated to 2.5% for the last quarter in 2024. So this is definitely not a welcome sign as far as the Australians are concerned. And we can see that the Australian dollars has been coming off very aggressively, okay? Now, in Canada, we can see that this is, again, a reflection of the round of rate cuts. Now, the US obviously has stopped cutting rates, but the rest of the world continue to cut rates. And this past week, we saw the Bank of Canada cutting interest rates from 3.25% to 3%, which is within expectation. Now, this has begun to be a trend from last May onwards, where they kept interest rate at 5% for more than 10 months, and since May of last year, this interest rate has been being cut in an effort to resuscitate the Canadian economy, which is in danger of slipping into recession as we are speaking. And now with this tariff war with the United States, it will almost certainly dip into a recession, which will actually have a negative feedback loop among all their trading partners. Okay, and Powell, which is the Federal Reserve, during this midweek itself, the FOMC meetings left the Federal Reserve decided that they want to leave the rate unchanged. Now, the Federal Reserve is actually one of the first to start cutting in rates, although they didn't cut as early as the Bank of Canada, which started their rate cutting rates in May of last year. The Federal Reserve started to cut rates in September last year, and it currently stay at 4.5%. Market also expect that the Federal Reserve will pause after 3 rounds of very, very sharp cuts, essentially bringing down the Fed fund rate from 5.5% to the current 4.5%, which is 100 basis points below what it used to be in the second quarter of last year. So the Federal Reserve right now is holding the line, and I mean to say that they are not looking to cut rates any further. I think the Federal Reserve is very concerned about Trump's tariff policy, which are likely to be very inflationary, and under such a condition, it will be disastrous to cut interest rates because that will fuel the inflation that may be coming as a result of Trump's economic policy in terms of using tariff to achieve his other priorities. Okay, so this is something that we also again must be watching out, at least for the first quarter of this year. It is very unlikely that the Federal Reserve will cut rates. And this is going against what Trump has officially demanded, that the Federal Reserve cut interest rate immediately. Okay, that has always been his call during the campaign leading to the November election last year. So we can see that Donald Trump right now is not getting his wish granted, and he is definitely not going to be taking this sitting down. Definitely, there are a lot of talks that he may actually fire the current chairman of the U.S. Federal Reserve, Jeremy Powell, which he appointed during his first term in 2018. So again, we are not sure whether this guy will be able to keep his job. His term does not end until 2027. So anything is possible in politics right now, okay? Now, as I said earlier on, Donald Trump is not very pleased with the fact that the Federal Reserve decided to hold interest rate unchanged, whereby he has demanded the interest rate be cut immediately. Okay, so again, this is something that we will see playing out in the months ahead. The tension between the administration and the Federal Reserve. There are even calls to eliminate the Federal Reserve altogether, and not sure whether that will even come into play, because I think there are other agenda going on, because Donald Trump has actually floated the idea of using Bitcoin to actually eventually somehow replace the US dollars. Okay, so again, we do not know what will happen. Of late, we have not hear from the man himself whether he's going to build a Bitcoin strategic reserve, something that he has flouted during the campaign leading to the election last year. Okay, so it has been 2 weeks since he came back to power for the second time, but he has not mentioned anything about this Bitcoin strategic reserve. Again, we will be looking out to see if there's any development on that front. Now, next will be Germany. We can see Germany GDP is in the tank right now. Quarter on quarter for Q4 of last year, we can see Germany economy has shrunk to negative 0.2% from a positive 0.1 in Q3. And we can see intermittently the Germany economy, which is the economic engine of the EU, is now spattering. We can see on a year-over-year basis on the chart to the right, you can see that GDP since Q4 of 2023 has been in the red. And this is the second year in a row in which GDP in Germany is in negative territory, meaning to say that for the past 2 years, from 2023 to 2024, we can see that Germany economy has been in recession. And this is definitely not a good development, because next month on the 27th, Germany will go into a general election. The current chancellor of the Scholz may actually lose the election. And right now, the polls are saying that the far right party may actually come into power. If Scholz actually lose the election next month, this market will go into another tailspin as far as German economy concerned. German even negatively impacting the euro as a currency. We can see that all this is pointing to the fact that the entire eurozone, as far as the EU is concerned, is going to be in deep trouble. All the other economies, we have France, we have Italy, and they are all not doing fantastically well. The only exception is Spain, that is barely holding the line. So the major economies within the EU now is on the back foot, and any kind of loss by Germany in the next month's election is going to negatively impact the entire European Union. Now, not forgetting that there is still an active war being fought in Ukraine. So will this EU, what you call NATO, be able to support to continue to support Ukraine in their war effort? Remains to be seen, now that Donald Trump has already spoken that he wants to pull the United States out of that conflict. Okay, so will the European be able to basically bankroll the war in Ukraine on their own? That again remains to be seen. But I think going forward in the next few months, the drum beats, the drum beats for war is going to escalate, and there's a very high likelihood by second quarter of next year we could be in a very full-blown war between NATO and Russia. Okay, so again, this will have negative impact on the global economy. Eurozone GDP number is no difference. We can see that on a quarter-on-quarter basis, it has shrunk from 0.4 in Q3 to 0. There's practically no growth in Q4 of last year. So again, from a very positive Q3 outlook, now you can see that the economy has come crashing back to earth with no growth on the last quarter. Now, on the year-over-year basis, it still shows somewhat a healthy outlook here. We still have a 0.9% growth in Q4, which is the same as in Q3. So by and large, we are not seeing the dire situation in the whole of EU just yet, but it will come because Germany, being the engine of growth, is now not performing as expected. Okay, and again, talking about the next month election in Germany, if the far right party actually wins, okay, they have already said that they are going to pull out of the European Union. So it is all very, very dire news coming out from Germany itself. So even if the current chancellor managed to win the election, he will be very, very weak because the coalition that he actually clobbered together up to now has been not strong. Okay, the Green Party is the one that has been holding the current chancellor's government together, and I think they are likely to be making a deal with the far right this time. Okay, so as far as the central bank is concerned, the ECB has again cut rates, but they're doing it very marginally. The main refinancing operation rate was at 3.15%. Market was expecting them to cut to 2.9, which they did. And the other major rates that they have cut is the rates on deposit facilities from 3% being cut down to 2.75%. Also with an expectation. So we can see all over the world, except for Federal Reserve, the major economies are cutting rates aggressively in a bid to refloat their economy. But I think now it's a little bit too late, too little. And what's coming up from the States is definitely going to have a negative impact on the global economy, in particularly Germany. Okay. Now we're going to see the GDP numbers for US. Again, it is a respectable number. It was at 3.1% in Q3 of last year. US GDP numbers has slid down to 2.3%, which is lower than what the market expect of 2.6%. So by and large, you can see there's been a bit of a slowdown in the US economy in the last quarter of 2024. But again, 2.3% is a very respectable number for a very mature economy like the United States. But you can see that there is a little bit of losing there's a bit of a slide in the performance in the US economy going into the last quarter. Okay, now with all these tariff talks, the impact on the economy is likely to be negative. So going into Q1 of this year, we can expect maybe the growth in terms of Q1 may not be as robust. Okay, hopefully it can still stay positive because we do not know whether the retaliation from the US trading partner is going to be very severe, which I suspect is going to be. Okay, because any kind of tariff is definitely going to cause a full-blown global recession going into the 2025. Okay, so this is what we have right now, 2.3% in Q4 of last year. I expect the Q1 to be a number that is going to be less than 2%. Now, as far as inflation in Japan is concerned, we are looking at Tokyo CPI numbers on a year-over-year basis. The headline CPI numbers for Tokyo was elevated from 3% in December. Now it's at 3.4%. So we can see an elevation in the inflation situation in Tokyo, which is quite reflective of the entire country. Okay, then when we take away the food and energy component of this CPI numbers, we can see that it has also increased, but marginally from 2.4% to 2.5%. But by and large, you can see both lines in the chart here. We have the green line, which is referring the year-over-year wholesale numbers, and the core CPI numbers are both elevated, and this is a situation that is causing the Bank of Japan to start cutting interest rates. This has been much likely priced into the market, but I think the fact that the Bank of Japan is now having the green light to hike interest rates when the whole world is cutting interest rate now, this is something very curious because right now I do believe the Japanese are doing what we call quantitative tightening. Okay, so they are trying to they are trying to not allow their existing treasuries, which is what we call the Japanese government bonds, to actually be rollover. They're basically going to let them expire. Okay, so this is doing what the Federal Reserve have been doing for the good part of 2023 to 2024, which is quantitative tightening. Okay, so we can see that will cause a side effect, which is what we call the the yen carry trade. We know the yen carry trade is massive. Nobody really know how much is in this yen carry trade, because it has been decades since the Japanese has been maintaining ultra low interest rates, which created a situation in which people are borrowing in Japanese yen to fund their acquisition and their position in equity markets. So if the yen is going to strengthen, right now the cost of borrowing in Japanese yen has just gone up. So it will negatively impact the yen carry trade, which will have a negative impact. So when we consider everything in consideration, it is definitely not a great development, but it is something that Tokyo has been trying to undo, because 3 decades of ultra low interest rates has not been able to bring about a turnaround in the Japanese economy, although asset prices has been escalating, but there is hardly any growth as far as Japan is concerned. So Germany retail sales again seem to be weakening from 2.5% in November. It has dipped to 1.8% despite the Christmas holidays. We can see that retail sales is beginning to wane, and this again is going to play out in the GDP numbers in the quarter that we are talking right now. Germany inflation rate, okay, there is a bit of improvement here. Inflation has gone negative. Germany consumer price index month over month has dropped from 0.5% in December of last month. Now it's currently a negative 0.2. Now this is about the lowest we have seen since last year. Last year we also have negative 0.2 before the spike to 0.5 in December. So now we are back to negative 0.2, which is not necessarily a welcome sign, because it shows deflation. They mean to say German consumers are not spending, okay? And if they can expect prices to be cheaper today, they will postpone their spending today, because tomorrow they could get better prices. So this is a sign of possible deflation, very much like what we are seeing in China right now, where prices, the CPI numbers has not been climbing, it has been retreating. Okay, so right now maybe we are seeing the same thing happening in Germany. Like I say, this is not a welcome sign. This is disinflation, and it could possibly lead to a deflation situation. Okay, then on the right, you can see the German consumer price index year over year for both the CPI and the harmonized index of consumer prices, which both try to measure the same thing, which is inflation. We can see that as far as the CPI is concerned, year over year, it has dipped from 2.6% in December to 2.3%, although market was expecting inflation to hold at 2.6%. So that is definitely a dip on the headline CPI numbers. The harmonized index of consumer prices has seen very stable grade. It has not moved at all. The needle did not move. It remains at 2.8%, which is one of the highest since September last year. So we can see that as far as the harmonized index of consumer prices, it is still showing inflationary pressure, because this number at 2.8% is the same number that we saw in May of last year. So it has gone down and now it's back up again from a low of 1.8%. Which is in September last year. So from 1.8% now it's at 2.8%. So definitely, if you measure the inflation using the harmonized index of consumer prices, it has definitely gone from bad to worse. Although for the month of January, it remains about the same as what we saw in December last year. Now, this is the numbers that we all been waiting this past week, which is the U.S. personal consumption expenditure. Now, remember, this is another measurement of inflation within the state itself. Now, the Federal Reserve do watch this number. In fact, this is their favorite inflation gauge. In terms of the core personal consumption expenditure month over month, you can see that it has bounced back up from 0.1 to 0.2. That's a 100% increase in the number itself. Now, when we look at a core for the year-over-year number, it has actually dipped from 2.8% to 2.6%. So this is showing a different story altogether. But I think the key one to watch will be this number, the year-over-year number, which if this trend continues to show lower prices in the core personal consumption expenditure year-over-year number, then the Federal Reserve will have the excuse to actually start to actually cut interest rate. But for now, I think it's already quite common knowledge that the Federal Reserve is taking a wait and see attitude. Okay. Now, in the coming week itself, we're going to have a series of very, very busy week ahead. We're going to have Monday starting out in Australia. We have retail sales month over month. We expect it from going from positive 0.8% to negative 0.7%. And this is for Australia. Then this will be followed by China releasing their Caixin manufacturing PMI numbers, which are expected to be remaining the same at 50.5. Maybe we're going to get a negative number, considering that the numbers that we saw of late is not being very, very good. Okay, and Eurozone, which is going to also release their CPI, their inflation numbers. We have the harmonized index of consumer prices month over month for the month of January. No expectation for this one, including the core. The previous month for the month of December was 0.4 and 0.5 respectively. Now, when we look at the harmonized index year over year, expected to bump up slightly from 2.4% to 2.5, and then when you look at the core, it's also is showing a slightly different picture here, a dip from 2.7 to 2.6%. So again, this will be crucial on Monday itself, and also on Monday we will also be seeing the ISM manufacturing PMI numbers, which likely to show a slight increase in the number from 49.3 to 49.5. This is obviously a contraction number. Unless the number can bump up above 50, it's just likely to be a negative reaction. Then Tuesday, we have nothing important. On Wednesday, we have New Zealand releasing their employment data, which is employment change. They expect the number of jobs created to increase slightly, but still in negative territory, from negative 0.5 to negative 0.2%. Unemployment rate expected to bump up from 4.8 to 5.1%. So we can see that New Zealand is definitely in a lot of hurt. The economy is in full-blown recession, just like the Australian economy. So this will be followed by the Caixin Services PMI. No expectation here, but if we can see what is being shown in the other sets of services PMI, it's likely to be an ugly number. Okay, in the US, we're going to be seeing the release of the private employment numbers, which is the ADP employment change for the month of January, expected to create 150,000 jobs. From December, 122,000 jobs. Again, this number is very volatile. It has never been accurate in terms of their expectation. So this will be followed by the services PMI in the States from 54.1 to 54.3. This will be a healthy number, but again, with all these federal employees now asked to retire, asked to go off, asked to be retrenched, I think in the months ahead, this number is definitely going to dip into contraction zone very quickly. Okay. And then on Thursday, we have the trade balance from Australia. We can see month over month, Australia is likely to see their trade balance actually decrease from 7.08 billion Aussie dollars to $7 billion. So this is again something that we have been seeing for quite some time. The trade balance has been decreasing month over month. Okay, then of course in the Eurozone, we're going to see the retail sales number for the year over year for the month of December. No estimates here, but the previous number for November was 1.2%. Then here we will have another one. The Bank of England will be deciding on interest rates. Market do expect them to cut by 25 basis points from 4.75 to 4.5%. This is already largely priced in, and we can see that happening in the sterling versus the dollar exchange rate. On Friday, we are going to have the employment numbers for Canada and the United States. Starting off with Canada, we're going to see unemployment rate to increase marginally from 6.7% to 6.8%. The number of jobs created is going to decrease from 90.9 thousand jobs to 48.5 thousand jobs. So we can see that economy, in terms of the labor outlook in Canada, is not very, very bright. Okay, now that we have the impending tariff war that's ongoing, that is going to be full blown come tomorrow, then these numbers in the next few months is going to get really ugly. Okay, non-farm payroll for the United States is likely to see a job creation of 170,000 jobs from December number of 256,000 jobs. Okay, so you can see there's going to be a huge markdown in the number of new jobs creation in the States itself. Unemployment rate is likely to remain stable at 4.1%. However, if it's anything higher than 4.1, it will be a negative. In terms of the earnings, average hourly earnings month over month in the month of January, expected to hold steady at 0.3%, whereas the year over year number is likely to dip from 3.9 to 3.8%. So this is what we will be expecting to see in the coming week itself. Now, having covered this, I will go straight into the price chart. Now, if you have any questions, do drop them into the chat box so I can address them as they appear. Okay. Now, as usual, I will start off with the Wall Street. We will start off with the Dow Jones itself. The Dow Jones actually has a spike earlier part in the week itself. Although there was a challenge of the all-time high, this is the weekly time frame of the Dow Jones. We can see the high traded was 45,061, marginally behind the all-time high that we see here. Okay, so this is something that we have again to watch, because in November last year, the Dow Jones hit the all-time high of 45,078, and this past week you can see there was an attempt to rally, but it was pushed back down. Okay, again, so far it seems that international money flow has been going back into the States. I think this is a reflection of what is really happening in Europe itself. When we look at the European economy, especially Germany's economy underperforming, there's a lot of capital flight that's currently happening, and those capital flight has found their way into Wall Street itself, resulting in the Blue Bell index here, which is the Dow Jones Industrial Average, benefiting from this inflow of capital into the States itself. And this is one of the reasons why I think the Dow has been as elevated as it is. But again, when we look at the overall picture, it doesn't look to be something that is sustainable. Okay, so when we look into the daily time frame, okay, so this is a daily time frame. On Friday itself, we can see that there was a sharp markdown in prices. Okay, prices tried to take out the all-time high in November, but failed and then closed as a very negative. This is a two-bar structure. On a two-bar structure, this is a decidedly very negative development, because with the way the market closed on Friday, it actually closed at the week's low. Okay, we have Monday positive, Tuesday positive, Wednesday mixed, and then Thursday there was a rally attempt, and then after that Friday we have a very low closing at the week's low. Okay, which is not a good development. So now we are beginning to see the negative sentiments rolling back into the this index itself. So I won't be surprised if we have a very weak and disastrous opening tomorrow in Asia. It will actually cause this market to actually sell off almost at the opening bell. Okay, so this is my take. When you look at the other index, which is, let's say, the Nasdaq 100, here we have Nasdaq 100. When we look at the weekly time frame, there was also a rally attempt, largely because the first day of sell-off in the tech stocks, in particular NVIDIA shares, it did not negatively impact the market, managed to rebound. Okay, however, the rebound was not strong enough to go beyond last week's high, which is at 21,944.6. So this way we have a high that is marginally lower at 21,846.3. Okay, so the closing is not disastrous, but again, you can see that the buying sentiment has actually petered out. When we look into the daily time frame, this is the development that we are seeing in the daily time frame. The market gapped down on Monday, went right down, okay, but managed to pull back up. Then on Friday, the rally attempt basically petered out, and it closed in a very negative connotation here. This is a classical pin bar happening on the daily time frame. This is very negative, although it is not as negative as the Dow Jones index here, but here it is a negative development nonetheless. So look out for further weakness in the tech stocks in the coming week itself. Then we take a look at the S&P, which has been the year's best performance so far this year. Okay, the S&P 500, which is largely a retail index here, has actually again managed to go into new high. And we can see in January, there's an all-time high being traded, 6,127.2, which is the S&P 500. Now, this has not been followed through this week itself. So we can see the high traded was marginally lower. The high was 6,118.5, which is marginally lower than the previous week high. But there is no fear of a reversal just yet, at least not in the time frame that we see in the weekly time frame. Now we look at the daily time frame. You can see daily time frame is very similar to what we see in the Nasdaq 100. We have not so much a critical closing in terms of pin bar, but again, you can see that it is the lowest of the last 4 trading days. Okay, Monday was weak, it closed weak because of the market gapping down in reaction to the DeepSeek fiasco. Then the market rebounded back, but on Friday the market failed to take out the all-time high at 6,127.2, and then it came back down to close on a weak note. In fact, it is the weakest in the last 4 sessions from Tuesday onwards. So again, this is setting the stage for a very negative reaction come tomorrow. Okay. As far as the European is concerned, let's take a look at the FTSE, okay, which is the UK index. The index has managed to climb to an all-time high. Now, this is quite a phenomenon because the UK economy is definitely not strong. Fundamentally, we are seeing a lot of weakness in the UK economy, but we can see the equity in UK actually managed to climb to all-time high. Okay, 8,691.7 is a new high traded this past week, and based on how it closed, it does looks that it may continue to climb for a little while longer. Okay, unless it totally reverses as a result of what happens in Asia tomorrow. Okay, but so far, technically speaking, there is no sign that the UK economy is going to see a top just yet. Okay, this is the daily time frame. The market, of course, pulled back from the all-time high, but it is not enough to cause a reassessment of the bullish outtake here. Okay, so basically in Europe, we can see equity markets remains very elevated, and this is setting the stage for what we call overvaluation. Okay, and over in the German, okay, we can see the DAX itself. DAX is also at an all-time high. We can see the all-time high traded at 21,801.9. This is definitely an all-time high, definitely not reflective of the fundamentals as far as the German GDP numbers are concerned. Okay, so this is definitely divorcing from reality here. So this is one of the index to watch out because the underlying economy is weak, whereas the asset in the equity market remains very robust. So this is in total contrast to what we can see. So as far as the daily time frame is concerned, there is no sign that the market is going to topple anytime soon, although there may be risk of a correction. But right now we are not seeing that in a very definitive way. So now we are finished with European. We are going to take a look at Asia. Principally, we're going to look at the Nikkei 225. As far as the Nikkei is concerned, on the weekly time frame remains elevated. We can see this is the weekly time frame. Now, the range of prices over the last month, you can see that it has been struggling. Okay, from the low here that we saw back in August of last year, the market has actually been retracing after the very, very sharp move as a result of the yen carry trade unraveling. So now the market is struggling to go higher, but although it has closed above 40,000 the week before, this week itself it closed back down below 40,000 to close at 39,300 thereabout. So this is again possibly something that will grind for a while before it starts to unravel. I suspect this trade war between Canada and United States is going to result in the auto industry unraveling. Now, we all know that Honda and Toyota have a production line in both Canada and United States. And if there's going to be a tariff tick for tack, then the auto parts that needs to go into the production line may not be available. There is a risk that production line in both Canada and United States, as far as the Japanese automakers are concerned, it could get suspended. Okay, so that will be a negative. I suspect that will be priced into the market tomorrow. So we have to watch tomorrow Asia opening for Japanese equities. Okay, so this is the weekly time frame. Let's take a look at the daily. Here is the daily. Did not close very strong. You can see that the market went up to a high of 40,608 and then climbed back down. Monday, we can see this big sell-off in sympathy with Wall Street, but the rebound is now back to about just marginally above 50%. And now on a close-to-close basis, it has come back down again. Okay, so again, I suspect that tomorrow when the market open and by the time it close, I think it will be much weaker than where we are seeing right now at 39,309. Now, the other Asian market to watch will be Hong Kong. Hong Kong has been, of course, closed for the Chinese New Year. So that means to say that it has missed out the entire DeepSeek fiasco. Okay, so tomorrow when Hong Kong market opens, we will have to see whether it will be reacting positively. I suspect it will not. Okay, but again, we have to see. The high trader is 23,264 even in the Hang Seng so far, repeating what we saw as a three-wave technical rebound, which has hit its equality level. So technically, it should be trading downwards unless this pattern here that we see evolve into something more complex. But by and large, we can see that the sentiment may not necessarily be working in favor of Hong Kong when it reopens tomorrow. Okay, so again, watch out for Hong Kong development. there's nothing to see here because for the last week itself, Hong Kong market has been closed for the holidays. So again, this will not be reflective. We want to see how the market reacts tomorrow. So this is equity markets for now. Let's go into currency. Now, the main currency to watch will be, I think, dollar yen. But for now, let's take a look at the euro versus the dollar. Okay, the euro versus the dollar, after rebounding for 2 weeks in a row, closed negatively, but I suspect that it's not over yet. This is basically on the weekly time frame. I suspect that it's going to be a bit of a rebound continuing, but the market closes a little bit weak on Friday, which is not very ideal for the bullish call right now. But I suspect, yeah, pattern wise, I think we may still see a rebound attempt again, okay, in the coming days, if not weeks. Okay, so this is based on the weekly time frame. Let me go down to the daily to give you a better understanding of where the market sentiment may be heading. So this is the daily time frame. The market seems to have overcome this resistance here, which I marked out at 1.0445. Okay, but the market has gone up 2 days before it comes back down again for the next 4 days. So the market actually closed on a weak note. This is a pin bar, suggesting that we may see lower prices immediately. Again, we will have to see how the market reacts tomorrow when the market reopens. But I suspect that this is going to be part of a corrective bounce. Okay, that may challenge the 106.30 high that we last saw here in December of 6th of December last year. Okay, so this could end up to be a three-way bounce for all I know. So this current pullback, so long as it doesn't break below 101.78, I think there is the prospect of the market, extending higher to correct this move here. Okay. Now in sterling has been reacting to the Bank of England's interest rate cuts. We can see that the rebound on Thursday has basically been priced in. The market actually went down to as low as 1.21, okay, before it bounced on Thursday, right after the Bank of England cut interest rates. You can see the bit of a bounce here, but Friday saw the market pull back a little bit. So this is the overall look of this pattern here. There was this rebound here from all the way back in August of 2022, okay, with a low at 103.63, and now they can see the market is doing this price movement here, okay. But by and large, the overall sentiment seems to suggest that we are still very much in a bull market, in a bear market here. So higher to sell, basically. So I think this is a trade that we should be watching out for the rest of this year. I think the dollar strength, technically speaking, is quite evident. Okay, and plus the fact that the Federal Reserve is not in the mood to cut interest rate, that will underpin the dollar. So going forward, I think if that's the case, there's a strong argument for a strong dollar for 2025. That means to say, correspondingly, we're going to expect lower currency prices for the rest of the majors. Okay. Now let's take a look at the daily. As far as the daily time frame is concerned, you can see the bounce from 121 all the way up to 125.25. Okay, so basically the market has tapered off over the last 4 days. We can see there is a bit of a pullback, but again, this is part of a structure very similar to what we saw in the euro versus the dollar. I suspect that the sterling strength, okay, which is going against the sentiment for a weaker pound, considering the Bank of England is in the rate cutting cycle now, should actually result in lower sterling rates. But right now we see a bounce here, which has actually started at the beginning of this year. It continues to be seen, and I suspect this is a technical rebound of a long-term downtrend. Okay, if you look at the weekly time frame, we already see that the sterling is in a long-term bear market. So this is part of that bounce here. Intermittently, I think there is a possibility the market may go higher to 126.60 all the way to 128. This is the bracket to watch out to reassert the if I'm going to be trading this currency pair, I'll be looking for selling positions within this area between 126.60 to 128.10. Okay. Now let's take a look at the interesting one, which is the dollar versus the yen. Now, of course, we knew that the Bank of Japan has actually hiked interest rate this week. It did not result in a massively strong yen. Okay. However, we can see that the yen has actually strengthened against the dollar. The dollar has actually come off a little bit, but not in the same degree that we saw the last time. The last time the Bank of Japan actually high interest rate resulted in a massive collapse in the dollar yen rate. Okay, now we are not seeing that because I think the Bank of Japan has learned their lessons. They are trying to provide forward guidance so that nobody will be surprised. They have already said that they are looking to tighten further, meaning to say to high interest rate further, but the market did not reacted in a very major way this time. The market is actually very, very benign come to this Bank of Japan latest guidance here. The high traded was 158.88, and we can see the market closes at 155.16. So there is a bit of a strengthening of the yen relative to the dollar, but not very much. So what do I make of this? I still think that overall the dollar strength is going to be very evident, and that is also going to be seen in the dollar versus the yen rate. Okay. Now let's take a look at a daily time frame to see if we can see something different here. We can see that this is a three-wave move, very controlled. Okay, from 158.80 down to 153.70. This very controlled three-wave pullback here. And on Friday, the market attempted to rally again. So there's a very good chance that this could be over and the market is going to resume its upside in the days ahead. Again, any kind of pullback, I think, is possibly a buying opportunity because I still think that the dollar will remain strong. Okay. Now let's take a look at the dollar versus Canadian. Dollar CAC here, we can see that the dollar strength is also very evident here. You can see this is the dollar strength. Dollar versus Canadian is strong at 156, just under 156. And this is understandable because of this ongoing tariff war between US and Canada. So I think Canada being the weaker partner here will definitely suffer in terms of their currency rate. So I think all bets are on the dollar winning this race for now. So it is currently showing that the dollar is having an upper hand relative to the Canadian dollars. So this is also currently playing out very much in sync with what we are seeing in the tariff war between US and Canada. When I take a look at the daily time frame, we can see that it's also quite evident here. Although the market has pulled back from a high at 149.64, 65, okay, but the market ran back up again on Friday to close at 146.27. So again, this is something that also says suggesting inherent strength in the dollar. So for now, there is still no sign that the dollar is kind of come down. Okay, but again, by and large, any kind of pullback is currently going to be met with demand. Okay. For those who are trading dollar Swiss, okay, dollar versus the Swiss francs, okay, I don't trade this currency pair, at least not actively. You can see that the market has hit a bottom here at 0.83 to 0.83 here. The market has been trading within this band of prices, 0.83 on the lower end, 0.92 on the upper end. So this is the band of prices that we have been seeing the dollar versus Swiss franc been trading. So there is no excitement here. But if you want to trade a range, so just know that the bottom range is nearer to 0.83 and the upper range is 0.92. Okay, nothing to see here. I'm not going to go down to the daily. What's interesting here, okay, I want to show you dollar versus Singapore dollars. Okay, I've been monitoring this because I have funds to convert. Okay, so we can see that the Sing dollars has been strengthening of late. Okay, this is based on last week massive pullback in the dollar versus the Sing dollar rate, and this week you can see the market has recovered back 50% of its original drop. So by and large, you can see that the dollar versus the Sing rate is in a long-term bear market. The dollar is strong, but against the Sing dollars, it is relatively weak. Okay, so you can see the highs are getting lower and lower, right? So this still conform to the long-term bearish outlook in the dollar versus Sing. Okay, so if you have to hold a currency between the dollar and the Sing dollars, it does appear that the Sing dollars is going to be the preferred currency to hold, at least for now. Okay, although there has been a change in the MAS currency band. Okay, I think they're going to loosen it a bit, meaning to say that it's not going to say that the Sing dollars is going to weaken dramatically, but we can see that the Sing versus the ringgit has actually weakened. Okay, meaning to say that the ringgit has actually gained an upper hand against the Sing dollars, which is something that I spoke about I think in December. Okay, so for those who are holding on to ringgit, maybe you want to hold on to ringgit for a little while longer if you're earning in Sing dollars, because I think the fact that MS is loosening their currency band does suggest that there will be some weakness going forward. But against the dollar itself, there is no particular evidence that that's going to be the case. Although we have a bit of a move downwards, okay, but still we can see that by and large, the dollar versus the Sing is in favor of the Sing dollars. Okay, right. I want to go into commodities. I want to show you the gold market. Now, the gold market has managed to go back to all-time high. So this is the all-time high. So there's the possibility this is going to be another surge in oil prices, in gold prices. Market traded at $2,817.16 per ounce this past week itself, suggesting that the pullback that we've seen from the previous high here at $2,790 is over and is likely to extend higher immediately. But be very careful with this gold trade here. There's a possibility February, we will see continued strength in the precious metal market led by the gold prices. But I'm not sure whether it is sustainable, because if the dollar strength come back in a big way, it is going to negatively impact gold prices. But for now, I think it does suggest that the structurally speaking, the gold market is starting to expand, to extend on its gain this week. Okay. At least for this 1-2 week, I think the sentiment and momentum will favor higher prices in precious metal, in particularly gold prices. Okay, now let's take a look at the daily time frame. Daily time frame, we have a bit of a reversal here. We have market hitting an all-time high at 2,817.16 per ounce and then close as a pin bar. But this is not quite a disaster yet. Okay, it is still higher than the previous day's closing price. Okay, so Friday price is marginally higher than the Thursday closing price, so that is not a negative so far. Okay, if there's going to be any kind of pullback, I think it's going to be bought up, okay, by international players. So stay positive on gold. I think gold has some more to go. And when we look at silver prices, now this is the silver prices has been underperforming. You can see the silver prices has not hit all-time high. The high traded the high here was last year at $34.86. It has pulled back in a less than ideal three-wave pullback with a low at $28.74. I suspect that this correction is not over yet. There's still a possibility of market will dip all the way back to $27.20 to as low as $26.50. So I'm still waiting to see if this is going to result in a more complex three-wave pullback. Okay, but so far we have seen silver has been underperforming. So all focus is on gold right now. Okay, so if you have to be bullish on precious metal, maybe you're gonna get a better result by looking at a gold market rather than a silver market for now. So this is the daily outlook. It's not particularly strong. You can see the market has been grinding higher. Yes, there was a surge on Thursday, but Friday ended up as an inside bar here. So there is no sentiment that suggests that it's going to be immediate strength. But again, by and large, if gold is going to stay elevated, I think the buying sentiment is going to spill over into silver eventually. But again, the movement here is favoring gold more than silver. Now we look at oil market. You can see the oil has actually been very strong. We can see that on a weekly basis. Now, oil market is basically lower to buy, in my opinion, because we can see that the market is doing a rounding bottom here. Okay, this is a rounding bottom that I've been talking about for quite some time now. The market have a bottom here at $64 per barrel, and it has basically been going higher, as high as $79 of late. And of course, the last 2 weeks, you can see a bit of a pullback. Okay, and we will have to see what impact the US tariff on Canadian oil and gas is going to play out. Okay, by and large, I think they want Donald Trump wants lower oil prices. But again, when we look at how the US has actually imposed further sanction on Russian export of crude oil, we can see that the marketplace is going to be a little bit short in supply. Okay, all the tankers that has been carrying Russian crude now cannot call on ports because there's an ongoing sanction by the United States. So ports, even Chinese ports, are not allowing Russian tanker to park. Okay, so that will be a problem, meaning to say that immediately the Russian crude oil is not coming into the marketplace. Okay, so that could result in a bit of a shortage. Okay, Donald Trump wants to increase oil production within the United States, but it takes time to increase production. Okay, from drilling to actually bringing the oil out into the market, it takes months, if not years. Okay, so it will take a long time. Okay, for in the meantime, there is a bit of a shortage in the currency, in the oil market right now. So this should be favorable to oil markets in at least in the near term. So maybe take a look at the daily. Okay, the pullback that we've seen has been quite sharp from $79.35 per barrel all the way to $71.70, even it's even lower, $71.65. Right. So this is the low traded as of Friday, but the market closed on a very strong note. This is a pin bar. So I suggest that going forward in the next few days, I think we will see elevated prices in crude oil prices. And this can be seen especially in the lower time frame. Let me show you the 1 hour. The 1 hour has been very aggressive. This is the 1 hour chart. Okay, so this pull up here, you can see it has been very, very strong. 2 days in a row, Thursday, Friday, okay, and the market closed at $73.40. Very strong development. So I think the momentum is favoring the upside, at least for now. Okay, so if you have got a chance to buy crude oil, I think you should consider, considering that the market is doing that rounding bottom on the weekly time frame. Now, last but not the least, we'll talk about crypto, and of course, we're going to talk about a big daddy here, which is the Bitcoin here. Okay, now Bitcoin is also negatively impacted by the tariff war that has just unfolded. You can see Bitcoin hit an all-time high of $109,567 just the week before, but you can see this week itself it has give back all the gains. Okay, so I think this is a corrective pattern, which I've previously mentioned that it may actually go all the way until March of this year. Okay, but I did not foresee the new high being traded. I was thinking the market was going to go all the way down and correct for the next 3 months. Okay, but now we can see the all-time high traded, but there's no follow through. Okay, and prices now are on the back foot. As we are speaking, Bitcoin has been falling since Saturday. So again, this is not a good development because the market is now hitting all the risky assets. Okay, so the sentiment right now is not in favor of risky assets as it is right now. Okay, because nobody knows how the tariff war is between US and Canada and Mexico is going to play out. As far as China is concerned, Donald Trump has slapped an additional 10% tariff on Chinese imports into the United States on top of the 17% that has been slapped previously. So we can say the Chinese retaliated by imposing a 75% tariff on American products. So China is not taking this lying down this time. Okay, so again, if this brinksmanship extends for extended period of time, it will be very damaging for the global economy. So again, not a good development. So we can see as far as the Bitcoin is concerned, we are beginning to see the three-wave formation, likely to see lower prices, initially targeting something like 93,500, at least for now. Okay, so whether it will accelerate to the downside, we do not know, but there are two catchment areas here as far as concerned. The one that is very realistically possible is anywhere between 81,000 to 85,000 per coin. Okay, so if this thing extend in a more complex manner, especially over the next 2 months leading to March itself, I think there is a possibility this level may be seen eventually. Okay, so this is the daily. I want to show you the Ethereum right now. This is the second largest, the biggest altcoin, and this is also not doing well. There was a marginal high at 4,106, but that was quite a while ago. That was in December last year. Okay, so this has been quite strong. This pullback here has been very strong, and at where we are right now at 3,058, this is about the lowest we have seen since this in November last year. So currently where the Ethereum is right now, it is at the lowest price in 2 months. So it's like definitely laying the stage for lower prices going forward. This is the weekly. Let's take a look at the daily. It is not disaster yet. We can see that this is playing out in a three wave. Okay, we have a rather odd looking three wave here. Okay, so I suspect this is going to be a 1-2, 1-2. So it's likely to go grind all the way down to perhaps as low as $2,400 per coin. Okay, to as low as 2,150. So anyway, within this blue area, I think it will be a great area to pick up some more if the market eventually comes into this area. Okay, so do watch out for lower prices across the crypto space here. The one that it has been quite volatile of late is the Ripple. When we take a Ripple coin, okay, prices has actually surged all the way to $3.40. This is not the all-time high, by the way. Okay, this is not the all-time high. The all-time high is I think $3.55. Okay, but here we can see that Bitcoin is losing some kind of momentum. Last week is still close positive, but right now where the price is right now at $2.74 is a little bit on the weak side, but it does not damage the bullish outlook here. The nearest bottom here where demand was last detected was $1.90. So if the price goes below sub $2, I think it will be a bargain. I think there's a lot of potential for Ripple. This week, Nikkei Shimbun, which is the newspaper for Japan, came out and said that all Japanese banks are deploying the Ripple blockchain onto their payment system. So this is quite a positive development. The only thing that's holding on to this to the value of this coin here is the outcome of the SEC appeal against their lawsuit against Ripple Lab. Okay, so that is still unfolding. Nobody know what will be the final outcome, but market right now is thinking that it will be a positive outcome for Ripple. Okay, so now that we have the ex-SEC chairman Gary Gensler now out of a job, going back to teach in MIT, the incoming chairman of the SEC is going to be crypto friendly, and I think that is going to play out quite nicely for Ripple. So this is a coin that I'm looking to buy. Honestly, I think if I can get something like sub $2, I think it will be a bargain. And I'm going to hold this. Personally, I'm going to hold it for quite a while. I think there's potential for much higher price because there is the end use case for this particular blockchain here. Okay. So again, taking a look at the daily itself, the market right now is coming off, okay, and it looks like it's accelerating. For the last 3 days, you can see that from Friday, Saturday, Sunday, it does look like it is the weakest so far compared to this bar here, which is like in January 15, okay. So we can see that prices right now is pulling back, is at a more than 1 month low. So it may actually accelerate to the downside. Immediate target is about $2.50. I'm hoping to be able to get something around here, ideally here, okay, below $1, okay. But I think that will be a bit of a stretch. I think that there's clear demand at $2 levels. So at best, I think a revisit to this now resistant and support line. Anytime the market can sit on this line here, maybe I'll be looking for buying opportunity. All right, guys, this is all I have for you. Unless you have something else you want to ask me, we still have a bit of time. I want to take questions if you have any. Looks like there's no question. And if that's the case, I will end the session. And thank you all for your time. And I'll see you next Sunday. Bye-bye. Mm.